Yo, yo, yo! What's going on, everybody? Hope everybody's doing fabulous out there. I am CPA Strength. I am the strongest licensed CPA in the state of Florida. What up? Can you believe it, man? I'm feeling good. Woke up in the middle of the night ready to get this in. Ooh. I'm going to show you right here that this is the best playlist in the world, and it will make all your dreams come true. If you're looking for accounting, if you're looking to level up in life, power up, step up, all the ups, like the elevator, it's like fast. It's like a very fast elevator over there. Anyways, this is Accounting for Beginners number 65. This is my classic series. It's the classics, man. You gotta get the classics, the basics. I teach the world basics, building blocks, building blocks, building blocks, building blocks, accounting building blocks. Yeah, on top and top and top. Anyways, we've been doing depreciation, and I'm just really excited for this one. It is straight line depreciation example. Now, I'll talk about the example in a second, and we'll get started. I'll try to start the video fast. I'll try not to make this long, but we all know how that usually goes because I just blah, 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 blah. But I've been doing, I've been just like talking about, like the theory or whatever about a certain subject. Like I did, accumulated depreciation, then depreciation, then we did straight line depreciation, then we did double declining balance with residual value, then we did double declining balance without residual value. So now I just want to do an example. This one, we're just going to do an example, and then hopefully we can use you can use some of the tools that I've taught you, and some of the tools that I've definitely reinforced myself on by looking at all these different videos. And yeah, so let's get started, man. Let's get started. All right. What's the problem? What's the problem, sir? Sir, no, what's the problem? What's your problem, sir? Man, I ain't got no problem, dog. Damn. I got no problem, dog. So, example, or the problem. I'm not a problem, man. Alright. Equipment acquired. Oh, and just to let you know, I wrote it out exactly as it was in the book I have here. So, we're doing... oh, shoot. I almost fell over. Anyways, we're doing it out of the book. We're doing the problem out of the books. But I wanted to write it how the book wrote it so we could decipher this together. I'm going on the fly, as you can see. I don't have the answers written out yet, so you can think about this yourself. You can hit pause, put you on pause, stop you like a comma. That's the thizzle dance, the thizzle dance. Woo! Fizz and peace, dog. Mac Drizzle. Anyway, sorry, dude. 4 minutes. Okay, so it's about normal, right? Equipment acquired beginning of year at a cost of $125,000 with an estimated useful life of 10 years and an estimated residual value of $5,000. What do we want to key in on? For depreciation, what do we need? We need the cost. Because what is depreciation really? We're trying to expense it over a period of time. The asset, we're trying to expense it over a period of time. So we want to do it equally or accelerated, or in this case straight line. I would think it'd be very basic, or if you think about it, what do you need to know how to depreciate? Well, you definitely need to know how much it costs. I mean, come on, right? You definitely got to know how much the thing costs, right? I mean, please. So, the other thing you're going to need to know is how far to depreciate it. What is the book value going to be when you're done with it, or what's the residual value, or when you're done using this equipment in your business, what's it going to be worth when it's all done? That's the residual value. So you're going to have to know what that is, because you're not going to want to depreciate the equipment further than that. So look, you're going to have to know the residual value of 5,000. And you're going to have to know, once you figure out the amount to depreciate, how many years. So you're going to have to figure out the depreciable value, how many years to divide that by, or how many years to depreciate that by. Sorry, 10 years. Does anybody remember the straight line formula? It's what is the straight line formula? No, I don't have it written down. Haven't done it in a couple days or a week or whatever. But so I'm thinking, I just picked out these three things. So you're gonna need cost, right? You're gonna need cost minus residual value over useful life. So we have all those things, and it said it's acquired at the beginning of the year, because that does matter, because if you would say you would have bought it half the year, you would only take half the amount of depreciation, because you're doing depreciation for the whole year. So you would I usually, if I had months, this is a little segue or whatever, but if you don't have a full year, I would, what would I do? I'd divide by, I'd get the annual amount for the full year. I'd divide by 12, so that would make the monthly amount. And then I would multiply it by how many months there is. But that's a little side note. If that freaked you out, don't worry about it. I'm sorry I even mentioned it. But at the beginning of the year, so you're getting a full year's depreciation here. But anyways, it wants to know the three questions here. Determine A, the depreciable cost, B, the straight line rate, and C, the annual straight line depreciation. Alright, let's answer these. This is gonna be pretty easy peasy, lemon squeezy. Or we can go the Shawshank Redemption, what's that guy's name? Brooks. Easy peasy Japanesey. But I'm feeling like the Austin Powers easy peasy lemon squeezy for this right here. Alright, let's do it. The depreciable cost. What is a depreciable cost? Well, they don't tell it to you here, but what do you think it is? What do you think it is? Remember, well, you bought it for this amount, $125,000. The cost minus residual value is the depreciable cost, because that's what you are going to depreciate the item, the asset by. So it would simply be 125,000 minus 5,000 equaling 120,000. So the depreciable cost is 120,000, and that's the answer to A. Alright, the straight line rate. How are we going to figure this out here? 10 years. It's 10 years. What 1 divided by 10 is 10%. That's the straight line rate. Because we're trying to figure out, because it has a useful life of 10 years, right? So we're going to do 1 divided by 10. Because we're trying to get per year out of these 10 how to do it. So 1 out of 10, that's 10. 1 out of 10 is 10%. There's going to be 10 of them. You're right? 10, 20, 30, 40, 50, 60, 70, 80, 90, 100. Yeah, boy. 10% is the straight line rate. That's the answer to number B. And the annual straight line depreciation. Now, how we get that? Because They kind of just led us right into that. You know, how would you get the annual straight line depreciation? Well, it would be our formula here, cost minus residual value, which is the depreciable cost over the useful life. So does that make sense? Because you've got an outlay of $125,000, that's an asset, so you don't have any expense yet. So it's going to last you, that $125,000 is going to last you 10 years. So you just, you know, divide that $125,000 divided by 10. But, I'm going to use my English, but there's a residual value of $5,000. So you can't depreciate all of that $125,000. You got to save $5 on the back end. So you're just going to do $120,000, and that's right. That's your depreciable value, $120,000 divided, right? 120K divided by 10 years equals. Is it? Oh Jesus, 12,000 a year. I hope so. Straight line annual depreciation 12,000. Yeah, it is. I just figured it out. Because I just figured it out. What does it all mean? So yeah, if you do 12,000 a year for 10 years, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. That's gonna be 120,000. It's gonna leave you with 5,000 left over, and that's gonna be your residual cost. All right, I believe that is going to be the end for this one. I guess now I can talk for a few minutes. I mean, but anyways, I want to leave this on a positive note. We gotta stay positive. We gotta try to better ourselves. Okay. One foot in front of the other. And I got a comment from someone the other day saying, oh, he's 32, thinking about going back to school, and you know, but he's motivated because he watched one of my earlier videos and stuff. And I was thinking, yeah, that's great. And I left a message back like, you know, if you're watching this thinking like you can't do it, you can't do this or whatever, but everyone has those doubts, but you just got to keep pushing through. And I can tell you, when I walked into the community college 8 years ago, I mean, I was scared. I was so nervous. You know, I had doubts then. I had doubts the whole way through. I still have doubts today, but I just keep on pushing on. And you know, that was one of the best decisions I've ever made in my entire life, was walk into that community college and tell them I want to be a certified public accountant. Anyways, dreams do come true. I got more dreams. I'm always dreaming big. So anyways, let's do this. Let's stay positive. I hope to see you in the next video. It's gonna be fun. It's gonna be fun. I can tell you that. Deuces.